Even with all of the volatility we saw last week, the market is still sitting near all-time highs. Investors are getting cocky as stocks keep climbing, even in the face of negative news. And remember, yes, October is historically the most volatile month of the year, and we have noticed red across the board this month, but the moves have been small, nowhere near crash levels. But ultimately, sentiment is shaky, fear is building, and yet, having said all of that, investors are buying at the fastest pace in more than a decade. Meanwhile, crypto saw over $19 billion wiped out last week, Bitcoin itself down more than 10%, and gold just reached record highs. Add together surging margin debt, and you've got a market that looks a lot less stable than it seems. Which brings us to something that should make everyone pay attention. Members of Congress are selling once again. So today we're breaking down the stocks lawmakers keep dumping, what that could signal, and why this might matter more than any headline you've seen so far. And last year, one well-known Congress member made over $24 million. In fact, if we just look at Nancy Pelosi's portfolio and more importantly her performance over the last 10 years, she's outperformed the S&P, which returned 253%, her portfolio up nearly 800. And it isn't just her, as we've highlighted many times before. As far back as the data goes, members of Congress not only outperform the S&P, but they do it by such a significant margin. And here's the kicker, 78 members of Congress have violated insider trading laws, and the penalty if they were prosecuted, well, we're talking a measly $200. So while the market looks strong on the surface with Trump walking back on China tariffs as well as Powell hinting at more rate cuts, there are clear warning signs. Regional banks, they're also flashing red, big names calling this a bubble, saying that the economy itself is in fact getting weaker and weaker, and Congress quietly heading for the exits. So let us dive into the biggest congressional stock sales right now and what they might be telling us about where the market is headed. Now, very briefly, we're going to run through 8 stocks. We're also going to give you our own valuation analysis, with number 1 on the list being Apple, which is up 9% in the last year. Year to date, it's pretty much flat. Over the last 10 years, yes, it has massively outperformed the S&P, but as we just highlighted, short-term performance isn't looking that great, and they're also trading very near to 52-week an all-time high, where we notice Seeking Alpha and Quant giving this a hold, and even with Wall Street's buy rating of 3.91 out of 5, that is very weak. Add together the forward valuation sits around 33, that is well above the historical average at 28, and on top of that, one of the highest it has been in the last 5 years. This is one clear indication of potential overvaluation, and you can also note the same conclusion when we look at the blue tunnel. Now, for new viewers, the blue tunnel does highlight the intrinsic or fair value. We're seeing this now above even the upper end. This again reinforcing potential overvaluation, something we have noted for quite some time in the last year. Apple has been trading at a premium, and only once during Liberation Day did it enter the undervaluation phase. In fact, if we zoom out to the last 5 years, you can see the other time before that was the beginning of 2023. Otherwise, this company does typically trade at a premium overall. And on the valuation, they get an F. They're trading at a 36% premium to the sector. They're trading at a 20% premium to their own 5-year average. And if we look at the price to earnings growth, very important for companies like Apple, 3.4, well above the sector, so a 90% premium, but even more relevant, they're trading at a 30% premium to their own 5-year of 2.6. And the other thing we'll do before we get into our own valuation, what are the institutions themselves doing? Well, 68% ownership overall. In the last year, they sold $161 billion worth of shares. They bought more than twice as much. We are talking about the same time frame. And in the most recent quarter, whilst we haven't got all of the data available, we can see for now they have been buying a lot more than they have been selling. If you wanted the reverse of the trend, well, they were net sellers in Q1 2024. And our own intrinsic value comes to $200 a day, derived solely from the DCF model. Now, our growth rate sits at 8%. That is below the most recent year of 9, slightly above the average of 7. But as always, the numbers that we use here are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for Apple or any others. Main takeaway though is if you are buying today at around $253, baked into the future free cash flow growth is 11.2%. That'll already give you a clear indication whether you see potential under or overvaluation. If you think this is way too low, then undervalued, way too high, then overvaluation. So we typically use the growth rate with the discount rate to get us the present value of future free cash flow and terminal price, where we add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, getting to 21% downside. Now, typically we do use the middle rate of 10%, but for this company, we do believe one of the issues they are facing is that lack of innovation, and that is why we have used the lower rate. We believe that to be more appropriate. If you want the middle rate of 10%, well, 232, still indicating downside that sits at 8%. Even if you believe we're being way too conservative at 12%, we're only talking about 6% upside. Now, we're not done, and today for Apple, like we have done historically, we are using the lower growth rate, and whilst we want to see at least a 10% margin of safety where we execute buy if it meets our 3 golden criteria, wide moat, strong financial metrics, good forward-looking data, that would be around the $180 level. So what this is flagging today, based on the lower growth rate for Apple, you are paying now a 26% premium, no MOS whatsoever, and Wall Street themselves, even with the weak buy rating, see this at 260 into next year, only 3% upside. Now, you may disagree and want to see it at the middle rate, which is fair enough. At 10%, you are still paying a premium. We're talking about the 9% point. Let us know though, do you agree with members of Congress? Is this one to consider selling, or in fact do you disagree and it's a hold or a strong buy? Before we continue, just to let you know, we have released our latest free weekly article. We drop one every single Sunday morning to your inbox completely for free, covering severely undervalued stocks as well as what's going on in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of October. Lots of information for each one, the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock they've been dumping is Micron Tech, which is up 81% in the last year, up 140% year to date. Over the last 10 years, huge outperformance, up more than 1,000%. And those who have been subscribed for quite some time will know we did videos at its 52-week low where we were calling this a screaming buy. Today it is sitting in fact at its all-time and 52-week high. Having said that, we know Quant still give this a strong buy. Wall Street 4.43, very near a 4.5 to also flip them into a strong buy. Seeking alpha buy, but on the weaker end, where it's trading at a forward P of 12.2, which is only marginally higher than the 5-year at 11.6. And actually, we are seeing it in a reasonable signal, given it does sit right around the mid to upper end of the blue tunnel. And in fact, this one intrinsic price has been growing from the beginning of the year and only continues to move upwards. And on the valuation, they get a B+ because you are getting a 51% discount to the sector, 84% discount to their 5-year average. On a price to earnings growth, this one is coming very low at 0.2, where the sector sits higher, so another discount of 90%. And in fact, institutions with their 81% ownership sold 11 billion in the last year, bought a lot more at 18 billion, but actually in the most recent quarter, they have been selling more, 315 million versus 89 million buys. Now, our intrinsic value at $176 is derived using a growth rate of 15%. Now, on the reverse basis, 17.4, so you need to believe it is going to grow higher to really see some nice upside. But if you use 6, 10, or 15, again, numbers are subjective, you can grab a copy below. Regardless of whichever one, each one is showing double-digit downside. For example, if you want to look at 20%, you can see $240, but maybe that is a little bit too optimistic. So even using the higher end today of 15%, you are similar to Apple, paying a 16% premium. There is no margin of safety whatsoever, and Wall Street themselves see 210 into next year, indicating 3% upside, so very minimal indeed. We can also just highlight here, look, even if you believe it should be higher, we take 20%, you are getting a margin of safety of 15, but that really will come down to whatever growth rate you believe is most appropriate for Micron Tech. So stock number 2, let us know, MU, is it a buy, hold, or complete avoid? We then move on to another one they continue to dump. It is in fact Google, up 55% in the last year, year to date up 34%. Over the last 10, another nice outperformer, trading very near to its all-time highs of $257. A weak buy rating from Seeking Alpha, but Wall Street again very near to a strong buy at 4.5, where it's trading at a forward P of 25, well above the historical 21.6. Feels like not that long ago it was sitting around the 15 to 16 mark, where it was at that point a very strong buy. And we can also point out that based on the blue tunnel, for the first time in the last year, this one is trading above, another potential overvaluation signal. But look, you had many chances to buy this severely undervalued, as we highlighted on the channel. Zooming out to the last 5 years though, one thing is for certain, if history was to repeat itself, then investors, like they have done prior, will get many chances to buy this at a discount. And the valuation at an F, 82% premium to the sector, although bear in mind, within the sector itself, there'll be a lot of really poor quality companies, a 7% premium to their 5-year. Price to earnings growth, whilst that does look good because below 2, as we say, is something that would get us interested, that is an 8% premium to the sector, but more importantly, historically they have traded lower at 1.36, hence a 22% premium. Now we notice institutional ownership at 40%, 58 billion worth of selling, a lot more buys. However, more importantly, in the most recent quarter, very similar to the previous stock, we notice they are selling more, 1.3 billion versus around 1 billion buys. Now our intrinsic price, $229, is derived using a growth rate of 12%, higher than the previous year at 5%, lower than their average, and baked in today is around 13.5%. Again, will give you a good indication of where you see the company, leading to an 11% premium if you're considering buying today. Now, if you wanted price targets at 10%, a buy at 206, at 20, a buy at 183, and 25, a buy at 172. Wall Street again, very limited upside into next year, 258, only 2%. And if you believe we're being, again, too conservative, at 14%, you are getting a margin of safety, but very minimal, not even at the 5% point. So let us know where you stand on Google today. The next stock they continue to dump is Microsoft, up 23% in the last year, year to date up 22%. Over the last 10, near 900%, trading at the upper end of the 52-week range. It is on a little bit of a pullback, near 10% from their 52-week and all-time high. A strong buy from Wall Street, a very weak buy from Seeking Alpha, where we see a forward P of 33 above historical 32, but only marginally, which is why we get the reasonable signal on the blue tunnel. In fact, it is sitting right there at the upper end. Again, another company during Liberation Day, you could have bought this below $400 in undervaluation. And zooming out to the last 5 years, one similar to Apple, where very rarely does it show itself as severely undervalued. And a rating of F because you are paying a 32% premium to the sector, slight premium to their 5-year, but price to earnings growth looking high at 2.8. 56 premium to the sector, 17% premium to the average, and with 71% institutional ownership, 111 billion worth of selling, more than 3 times buying though in the same time frame. Institutions have been buying a little bit more than selling in Q3. Now our intrinsic value of $501 derived using a 16% growth rate does in fact lead to very minimal downside of 3%. Baked in is slightly higher at 16.3, meaning if you believe that to be accurate, you are paying a 3% premium. Now, unlike the previous companies we've looked at today, Wall Street actually see upside with this of 23%, $632 into next year. And if you wanted this on the watch list at 10%, a buy at 451, at 20, 400, and at 25, around 376. If you wanted to look at the upper end, bear in mind, average over the last 10 is 14. Using 18% growth rate, you are sitting now at an 11% margin of safety. So let us know on Microsoft today. The next stock they're dumping is Salesforce, down 17% in the last year, down 27% year to date. Over the last 10, marginally outperforming the S&P, up 209%, very near to 52-week lows. Double buy from Seeking Alpha in Wall Street, fairly respectable, 4.36 out of 5. Where we see massive disparity from the average, 20, well below 30, so that is potentially a severe undervaluation. And that also shows itself when we do look at the blue tunnel disparity between the bottom end and the share price today. This one, though, very rarely has even entered into a reasonable signal, so the market does in fact trade this consistently at a discount. Worth highlighting, though, that the intrinsic price or fair value has decreased slightly in the last year. Zooming out to the last 5 years, better picture in fact from 2022 to the beginning of 2025, this one has consistently traded at a massive discount. But even more important than that, middle of 2024, the intrinsic price has only been decreasing. And they get a D on the valuation, 15% discount to the sector, 43% discount to their 5-year. Price to earnings growth looking appealing, 1.25, 30% discount to the sector, historically around 2, so you are getting a 39% discount to their own 5-year average, where institutions with their 80% ownership selling 29 billion have been buying a lot more. However, we have noticed in Q3 they were net sellers as opposed to net buyers. Now, our intrinsic value, $369, using an 8% growth rate, which is the lower end today. Baked in is only 2.1%, so if you're a fan of this company and believe over the longer term things will be okay, this could be one to consider. And if we go the other spectrum at the higher end of 12%, well, what we're looking at today is pretty much a double. So at the lower end of 8%, you are in fact getting a 34% margin of safety. Wall Street fairly bullish, see this at 326 into next year, 34% upside. And if you wanted this in fact at the middle rate, then you would be looking at quite a hefty MOS. We're talking around 43%. So let us know, is Salesforce a sell, hold, or strong buy? They continue to sell ASML, which reported earnings not that long ago, up 47% in the year, 49% year to date. Over the last 10 years, up in fact around 1,000%. Another company we called as a strong buy, very near to its 52-week lows. We also see a double buy from Seeking Alpha from Wall Street, where it's trading at a forward P of 35, slightly above the 5-year of 33, so potential overvaluation. And it's also noted for the first time in the last year, we are seeing this pretty much at the upper end, if not slightly above that blue tunnel point. Again, potential overvaluation. Something in the last 5 years, this company has traded both at a premium, both in a reasonable signal, and in fact undervalued. So if this is one on your watch list and you have patience, it is more than likely it will come back down to an undervalued level. Now, an F on the grading, when we look at the price to earnings growth of 2.1, 18% premium to the sector, and in fact a 21% premium to their average, and institutions with 26% ownership selling 12 billion, buying actually less at 10 billion, bought a little bit more this quarter than they did in fact sell. Now, our intrinsic price, $909, is derived using a growth rate of 12%. Baked in is near 14%, meaning unless you see this above 14%, then it does look to be potentially overvalued. Using the middle rate though of 12%, it does in fact mean you're paying a 13% premium. At a 10% MOS, a buy at 818, at 20%, a buy at 727, and 25, 681. Wall Street themselves, 1050 into next year, only 2% upside. And if you wanted to see at the upper end of 14%, well, we're talking a margin of safety just about that 2% point. The next stock they're dumping is Oracle, up 66% in the year, up 75% year to date. Over the last 10, up 666. Trading near enough around the upper end of the 52-week range. Double buy again from Seeking Alpha and Wall Street, where the forward P 41 well above the historical 19. That is a potential massive overvaluation signal, and that's also shown when we take a look at the blue tunnel. Huge disparity, only increasing since around April. This one definitely looks like a potential red flag indicator. And if we zoom out actually over the last 5 years, this one only really entered into a reasonable signal around midpoint of 2022, and they're trading at a 71% premium in terms of a forward P to the sector, 106% to their 5-year average. Price to earnings growth 2.1, 15% premium to the sector, only 5% to their 5-year average. And institutions with their 42% ownership sold 25 billion, bought a little bit more at 33 billion, but they sold more than twice as much in the most recent quarter. Definitely net sellers. Maybe they are starting to get a little bit nervous. In our intrinsic value, $198 derived using a 20% growth rate actually means 32% downside. Even if you want to go higher at 25, downside of 4, showing us that today baked in on a reverse DCF is 26%. So using the middle rate, as you noted here, you are paying a 47% premium. If you don't agree and you believe it should be higher, well, even at 25%, you're paying a 4% premium. Wall Street themselves see 346 into next year, 19% upside, but let us know where you stand with members of Congress or with Wall Street, or in fact see it as a whole today. This then takes us to Costco up 6% in the last year, year to date up 2, over the last 10, up 500%, trading towards the lower end of the 52-week range. Just one buy rating from Wall Street at 4.05 out of 5. Similar to what we noted from Oracle, huge forward P of 47 in isolation and also above historical 40, another potential severe overvaluation signal, which is also reinforced when we look at the blue tunnel, although for the first time in the last year, we are seeing it head towards the upper end of reasonable signal, maybe one to have on the watch list if you do like it moving forwards. Over the last 5 years though, if you wanted this in a reasonable signal, you would have to go to 2023, but also it does for quite a long time trade at a premium overall, where it gets an F on the grading, a premium to the sector of 188%, 9% to their own 5-year, price to earnings growth above 5, 95% premium to the sector, 24% premium to their average, and institutions with their 68% ownership sold 25 billion. They bought more than twice as much, but look at that, 1 billion worth of selling in Q3, only 175 million worth of buying. The only other time we have seen this in the last few years was in fact in Q2 2023, when there was massive disparity between the selling and buying. And our intrinsic price, $829, is derived using a growth rate of 15%, which you could argue straight away is quite high. Last year growth was at 18%. Baked in today though is 16.7%. You'd need to sit above that, around 20%, to get some decent upside. So using the middle rate, you are still paying a premium of 13% today. 10% MOS, a buy at 746, at 20% a buy at 663, and at 25 a buy at 622. Wall Street though see 1090 into next year, 17% upside, and will also just show you if you're very bullish, believe 20% to be most appropriate, then you are getting a 20% margin of safety. So let us know about Costco as well as the other companies covered today. Are they a buy, hold, or complete avoid? Don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.